Welcome back. This is part 2, continuing our breakdown of hidden risks in M&A. In part 1, we covered customer concentration, owner dependency, inconsistent financial reporting, and undisclosed liabilities. Now let's talk about what often hits right after closing: working capital and cash flow surprises, systems and reporting issues, and key employee risk. Hidden risk number 5, working capital and cash flow surprises. This is where many acquisitions look profitable, but the buyer still feels cash poor. They may buy a business and realize inventory levels are low and must be rebuilt immediately. You may realize receivables are slow and need aggressive collections. You may realize payables are due sooner than you expected, and you may find out that the business depends on a credit line you don't have access to. Maybe the company has seasonal cash flow swings that weren't obvious. So you want to ask a few specific questions. What does a normal month look like for cash flow? What does the worst month look like for cash flow? And what happens when you add your own financing payments on top of all of that? Because cash flow is what keeps the lights on after the deal closes. Hidden risk number 6, systems and reporting that do not translate. This one surprises owners because it sounds administrative, but it hits financially. If the target business uses a completely different accounting system, or doesn't track job costing, for instance, or doesn't track inventory properly, or has payroll processes that are informal, then you have a real integration cost, not just time, but money. You may need new bookkeeping support or new systems, may need some cleanup work or policy changes, training even, and months of adjustment before reporting becomes reliable. If you don't plan for this, your first 90 days can feel really chaotic, and you may not even know what your true profitability is during the transition. Hidden risk number 7, culture and key employee risk. I'm not talking about corporate culture here in a buzzword kind of way. I'm talking about a simple reality. If the business depends on a few key people, like the estimator or the operations manager, the lead tech, or the plant supervisor, and they leave after their transition, the business will stumble hard. So the question is this: who are the key employees and what incentives are going to keep them here? What is the relationship to the owner, and what does it cost to replace them if they do leave? Now let me tie all of this together. These hidden risks do not mean you should avoid buying a business. They mean you should price and structure deals with reality. Because a smart acquisition is not the one with the biggest revenue. A smart acquisition is the one where the earnings are real. The cash flow is sustainable, the risks are understood, and the purchase price reflects what is actually going on. So here's the takeaway. In M&A, the